the opportunities emanating from AI are massive. AI is an exponential layered on top of an exponential layered on top of an exponential, right? These chips are getting like 10 times better, 2 times per year. These algorithms are getting like multiples better every few months. And the decrease in token price, the use of tokens, these are all exponentials. And analysts in the market are not good at exponentials.
All right, well, thank you to everybody for joining us today. We're obviously, in a different macro environment. Geopolitics are different, fiscal policy is different, and expressing opinions in this regime are obviously, a new challenge. And so, Mark, I wanted to start with you and just understand how you're thinking about this current regime.
Yeah, happy to start. So the way we're looking at the world today, I think there are really 3 big themes that characterize a lot of what we're focused on and working on. The first is AI, obviously, right? AI, I think, is one of the most significant events that we'll deal with in career, at least my career. And it's very complex, multifaceted, and something that we're all figuring out as we go, but that's certainly something that takes a lot of attention. And one of the areas in particular is understanding AI CapEx, given the magnitude of it. And so that's something we'll come back to. The second theme is the changing world order. The number of conflicts that are occurring, I think, are a result of a period of deglobalization that we're living through and the movement of supply chains, et cetera. And then finally, the one we spend our most time on is like, what does that mean for market pricing? And a related piece of that is the central bank and fiscal authority reaction function. And one of the themes that we continue to focus on is that many of the policymakers seem very comfortable taking risk with inflation and very uncomfortable taking risk with real growth, right? So they're very happy and willing to provide policy support if the economy looks to be faltering at all, and are very comfortable taking a wait and see approach to potential inflation issues. As a result, just as one example, the Fed has missed its inflation target for 5 years running, and is, more often than not, until very, very recently, been contemplating adding additional cuts into the economy. And again, I just think that's symbolic of this approach of basically, hikes are bad, cuts are good. That is the mantra that, it's very simplistic, but you can see it all over the place.
But I mean, this seems to be like a moment where we're going to pivot from this post-GFC thinking to the new regime. And so, how does the Fed play into that when, to your point, after the global financial crisis, we really saw, a lot of support being pumped into the economy by various central banks around the world.
I mean, one comment, and then love to hear from you guys. But one of the other aspects of this period we're living in is that it's one that's characterized by negative supply shocks, not positive supply shocks, right? For 2 decades, we lived in an environment that was largely characterized by significant positive supply shocks, and central banks were largely dealing with demand shocks, right? And in that context, because inflation through that period really wasn't a big threat, it gave central banks tremendous latitude to use monetary policy aggressively to support demand. Today, like COVID was the first one, but we're in a number of them right now where we're seeing significant supply shocks, negative supply shocks, where monetary policy is not necessarily the best tool to deal with that. And so it is different in that way.
I would actually flip it from what you were insinuating, right? Like, to his point, they seemingly were adding a lot of liquidity, right? And they were conducting a lot of non-conventional monetary policy in terms of forward guidance and stuff. But the reality is, due to the nature of the financial crisis, any monetary policy prescription would have told you rates needed to be deeply, deeply negative, and you needed to have a very big fiscal impulse. And you weren't able to accommodate either of those things. So even though the Fed was constantly rolling out new measures. In totality, the policy backdrop was more restrictive than it needed to be, right? And therefore, you just had a very low period of low nominal growth, which is exactly what you would supposed to be get if you didn't have enough monetary or fiscal. Now, conversely, even though rates are higher, right, and they're not doing QE, you have a very, very large fiscal impulse, right? So you have 6% deficit on a $30 trillion economy. That's almost $2 trillion of aggregate demand that you really shouldn't be getting at this point. And then on top of it, to Mark's point, you're getting another $1 trillion spend via the private sector, right, by the same companies that were super cash flow positive before. Mm-hmm. Now we're becoming cash flow negative, right? So that's another $1 trillion. That's another 4%. So now you have 10% of GDP of like new aggregate demand that you haven't had before. Mm-hmm. And that aggregate demand is creating a very high level of growth, right? That is creating very big corporate earnings. So it's filtering into very easy financial conditions, right? And the Fed, to his point, like, they're not really, we could debate where neutral is, right? But neutral is kind of objective. If you're running inflation above trend or above target for 5 years and real growth above your real growth target for the better part of 5 years, then it's hard to make the argument that this level of rate is really restrictive. And to his point, like, even though inflation is going the wrong way, they're not hiking. Which means they're adding to that flywheel. So you have this flywheel going on. And therefore, from a rate point of view, it's actually interesting because unlike the post-GFC period where you weren't getting enough policy impulse, and therefore being long rates was your hedge, right? Now I would argue, if you think about that flywheel, where you have a lot of growth that's being financed by the government deficit and the private side deficit, you really need the thing that would upset the equity market is a much higher level of rate, right? Because for investors' love of whether it's all in credit or this level of rate, total return on that's been basically zero for the better part of 3 or 4 years.
Yeah, and I want to get back to the inflation conversation in a minute, but Zach, to bring you into the conversation, for the first time in a while, it seems like the U.S. might not be leading the way in terms of, monetary policy. How do you see the global central bank alignment when it comes to dealing with persistent inflation?
Yeah, well, I'm not sure chronologically there may be a central bank who's going to hike before the United States or the Fed, but I do think that the U.S. is actually still in the driver's seat of the global economy in the sense that the U.S. is sort of ground zero for this CapEx boom related to AI that Brian was talking about, and I think that's one of the most important macro features of the environment in terms of driving demand and driving inflation. And so I think that when you step back, you look at the fact that the Fed, as you've mentioned, missed its inflation target for 5 years in a row, and you now have an unemployment rate that's still at a 4 handle. You have this 4% of GDP in CapEx boom. It was sort of inexplicable why they were priced to be cutting rates coming into this year, and I think that the Iran war as a catalyst, I don't think it's causing the inflation, right? The inflation was there already, but it sort of forced people to take a hard look at where policy and conditions actually are and really say, look, we can no longer keep justifying this sort of wishful thinking that Fed easing is going to come in and continue to juice the economy. And so I do think that, the U.S. is, pivoting more towards people starting to expect tightening is basically, is indicative of how stuff is going globally. And I think it's also interesting to note that, this is people have talked for a long time about sort of China as the engine of global demand. That's really falling off, right? I mean, China is not doing well. They're exporting sort of all kinds of excess capacity because their domestic markets, basically, they can't get enough demand to consume everything that they're producing. Their housing market is in a multi-year slump, the likes of which, if you saw it in a developed economy, it would be sort of catastrophic. And really what's driving global demand, and you see it in terms of the supply chains, it impacts Asia, it impacts every region of the world, is this huge CapEx boom. And so I think that, that's leading to a tightening in policy where the US actually is kind of setting the tone and setting the stage for central banks everywhere across the world. The biggest exception to that, I would say, and we've heard this is an out of consensus view, is while it's appropriate for most developed world central banks to be hiking right now, the one place where people seem to be sort of most concerned that hiking is not happening fast enough, where we think it's actually not needed, is Japan, right? People have been looking to Japan to have some sort of rapid rate hiking cycle, but if you actually look at their inflation as measured congruously or in the same terms as most global core inflation metrics, meaning ex food and energy, it's been below 2% for years and falling, right? And Japanese real disposable income growth has been negative for the past several years. Only now is wage growth in Japan actually starting to outpace inflation. People have talked about big years for wage growth there. So, I think basically everyone else is kind of led by the US pivoting much more towards hiking in a way that's finally appropriate. The one place that maybe, people are expecting that to happen where maybe it shouldn't would be Japan.
So, with that said, is there one place, I guess I'll open this up to the group, is there one place that the bond market is really getting it wrong right now?
I would say less one place, and I think kind of the constant weave through all of them, I would say, is that the level of rate in all of them is basically too low, right? Again, I think these economies are fairly indistinguishable in the fact that in every economy you have an outsized deficit, even though real growth is okay and inflation is at or above target in each of them. You have the fact that you have election after election in every region of the world where you have more of a right and a left candidate, both of which are running on platforms which are deficit additive and not taking away deficits.
Yeah.
And you have, again, this new, globally, you have this new technology spend, right? And it's just a very different backdrop that we haven't seen before, right? Like every government is spending on energy security, on defense, on bringing supply chains back home, and now technology. And that's going to be a constant, right? Because it's a matter of national security everywhere, right? So these deficits are only get larger, right? Which means that it's very hard to expect nominal growth to fall a lot, right? In absence of a shock, right? Because it is too much aggregate demand, which again is keeping financial conditions everywhere easy. So I think really it kind of sustains until people realize that they're just not getting paid enough. Because really everywhere the level of, especially the derivative rate is lower than where nominal growth is, right? And when you kind of combine that with this technological change that you're getting, right? I think like the big manifestation of all of this would be in credit versus equity.
Yeah.
Right? Because you have, if you look at all in credit, right, you have your, call it IG or spread component, which is very highly correlated to the S&P. And those two trade kind of tick for tick and have been. And then you have your rate component, which again is long in credit, and people look at that as kind of your risk parity, right? But as I mentioned before, like I think that's wrong way risk here, right? You actually want to be short rates, and you certainly wouldn't want to be long the 10-year rate, as part of your all-in credit. And again, look at the total return of LQD, right? Like over the past however many years, it's essentially been zero. Whereas if you break up the components and you said, okay, instead of my credit component, I'm long the S&P, and instead of the rate component, I'm going to be in bills or something in the front end, you would have had a significantly, like almost any sort of combination of how, what you wanted to run them with, you would have massively outperformed all in credit, right? And that will continue because the reality, the difference between credit and equity is credit is kind of bounded to the good, right? Like in credit spreads, you're bounded towards tighter credit spreads of zero, where equities are the other way around. Right? And when you have these new technologies that have these fat tails, you want to be long that tail, not short that tail.
Right.
And when you have a technology that's going to create winners and losers, that will be very good for a portfolio of equities, right? Where your winners will be the biggest companies in the world and your losers, even if they go to zero, are nothing. But that math doesn't really work out well for credit, where your winners are at a par and your losers are at a 30 or 40.
Yeah, and I think it kind of goes to, Mark, your earlier point about this being a shift from a demand economy post-GFC to really like a supply constraint economy with all the CapEx related to AI. So, like, in your mind, how does that, how do you make money off that worldview?
Yeah, so, I mean, if we look at the bond market today, I think actually post the most recent job report, the bond market, at least in front-end pricing, from our perspective, is pretty fair at this point, which is a big shift from where we are. But the Fed is now appropriately, I think, priced to actually hike a couple times. But we have a big unknown coming, right? We have a new Fed chair. We're going to hear from him next week for the first time. I think there's still big unknowns about how politicized he is relative to what the administration wants. Trump just the other day said, it's really up to him what rates should be, and then in the next breath, and he should cut, right? And so we know this is an issue. We know the market has priced this to some extent, but one of the trades that it potentially opens up, depending on how it goes, is I think the term premium trade that you're alluding to, which we would agree with, that term premium seems too low in a world where developed market debt levels continue to be extremely high. And I think the only reasonable way out of it is actually that they continue to have nominal bond yields below nominal growth in a way that they can start to try and stabilize these debt loads and hope like crazy that the productivity gain from AI actually comes through. But that is definitely a consideration today and I think the Japan example, the Fed is the most important central bank in the world, but you could argue that the BOJ is actually the leader of where central banks are going, in that they have been very much captured by their political system and the debt load. And so even this hike that's finally going to happen in June, whether they should or not is a different question, but the trade-off seems to be that an agreement at the same time has been come to stop doing quantitative tightening. So basically for the BOJ to stop reducing their balance sheet, all while the BOJ or while the Japan fiscal side is going to add additional fiscal stimulus into the economy. And so one question I would have for you in your view on Japan is, if they shouldn't actually be tightening, why is dollar yen at 160? Why is the curve the shape it is? And why is loan growth in Japan absolutely ripping?
Yeah, well, you have to put it in the context of where Japan has been, right? Japan has literally had decades of deflation. Their banks have been, shrinking their balance sheets, right? Sort of deleveraging for decades. Arguably, and with inflation below target and real wage growth only recently becoming positive, right? The BOJ's own metric of the output gap that they publish is still below zero, right? Juicing the economy is what the central bank should be doing, right? Getting loan growth back into positive territory after several decades. That's exactly what they should be doing, right? And so I think that's a big opportunity for Japanese equities as well. And the weak currency as well is a huge benefit to Japan. I mean, people think that Japan is no longer sort of really an export story, which first of all, I mean, they still export a lot, but to the extent that their corporate sector is not exporting as much anymore, it's because they've literally offshored the production, right? But from a sort of corporate income and balance of payments perspective, that looks very similar. It's just instead of producing it home and then sending it on a ship abroad and the money comes back, you produce it abroad and then ship it by truck or whatever, and the money comes back, right? So you still have this huge corporate exposure to foreign revenues, and keeping the yen weak, it's sort of the classic scenario for boosting exports, boosting corporate profits, and the corporate sector is really key in Japan to getting the sort of virtuous cycle that they want. It's in most developed economies that haven't had deflation, people think the wage price cycle is vicious, not virtuous. But in Japan, that's what they're trying to get going, and you just can't have that without a corporate sector that is has its profits really really strong. And so the BOJ also has other tools to defend the yen, right? FX interventions, mess around with domestic economic conditions a lot less than rate hikes. So again, you always have to ask yourself, what problem are we solving, right? By hiking rates, is inflation too high? Is the economy, super overheated, right? And I think if you just look at the sort of the data in Japan, the answer to those questions is not really. So, but I do think that the rates markets in general, just switching to the longer end, I do think that this sort of point about the fiscal irresponsibility is an interesting one, because for the first time in a long time, I think you really have some sort of fiscal premium baked into the term premium. And that became most dramatically apparent, I guess, with the sort of Liz Truss budget, where all of a sudden it's like the UK started to look like an emerging market in terms of how people were reacting to it. And that's, I think, something that the equity markets are ultimately going to have to grapple with, where you have this sort of fiscal term premium, you have the fact that rates in general should be going up in response to this sort of inflationary CapEx boom and fiscal spending that's juicing demand and sort of keeping demand strong. At some point, these two things are there's going to be a tipping point where the benefits of the increased demand from all the fiscal policy, which obviously accrue very much to corporate earnings, is going to have to be outweighed by the fact that, okay, there's just a level of interest rates where, especially when you're in a CapEx cycle where financing has to be secured, there's going to be a tipping point where the one starts to outweigh the other. And I think that's, we're starting to get on a trajectory towards where that could be a concern.
So one thing I want to bring in is all the geopolitical risks that exists out there, right? So as we've learned over, the past year or so, there are, unexpected events that can, impact markets in a pretty massive way. Like, how do you position, Brian, your portfolio in a way that, protects against the geopolitical risk that exists right now?
Yeah, look, so I wouldn't, not to quibble over semantics, I don't think it's necessarily the geopolitical risks, right? Like the conflict here or there, like the reality is like you had Russia, Ukraine, and if you would have told people 4 years ago that it was still going on, right? No one would have wanted to be long the DAX or anything Europe or whatever. So I think I don't view it merely as that. I really view it more as the direction of travel of everything that we're saying, right? Where we're living in a world where you're going to have a lot of debt-fueled demand, right? You could call it geopolitical or something else, but for every country to do more around defense and energy and technology and reshoring of supply chains. And I think in that world, and when you layer on the fact that you have such a disruptive new technology where irregardless of the path that it takes, right? At this point, you're pregnant enough that whether or not it kind of underperforms or overperforms, you're locked into very big moves.
Yeah.
Right? Like, I just think...
You talked, before in our call about like looking for cheap convexity.
Yeah, volatility is just too low, right? Like, we know why volatility is priced relatively low because the microstructure of today's market is such where you've just kind of layered on a lot of vol selling. So you have the proliferation of these ETFs that just overwrite calls all the time. You have these QIS strategies that the banks do where they systematically sell vol. You have all of this vol, irregardless of the asset, that gets sold to the market to where, just call it dealers, are long gamma locally. So what that means is that day to day, your realized move might not be very high, right? But what happens is when you have this new regime where all of these things are kind of going the same way, when you have a low level of volatility, implied volatility, emanating from that low realized, it just means that your terminal distributions are very, very low, like tight, right? And when you have these kind of big moves, like if you would have just been buying, out of the money calls on the S&P or NASDAQ at relatively low vol, it's like you've just constantly overshot them, right? And the same thing is like on the downside, if you want protection, right? Like index vol trades very cheap because correlation is priced at the lowest it's ever been. So single stock vol is the absolutely richest it's ever been versus the index, which may be okay in an up market, but in a down market, correlation goes to 1. And the index just, again, is much too cheap. So I think whether it's looking at kind of index vol in equities, whether it's looking at the very long end of rates, where a lot of these governments did a good job of issuing very long duration bonds when rates were very low. And now those long duration bonds, because rates have risen, trade at a very, very low dollar price. So they have a lot of convexity to them. So you get very cheap convexity with positive carry. Like you could find pockets of this cheap volatility in every asset. And it offers a lot of protection because the market is not very good at pricing kind of terminal distributions when you have this kind of disruption from the regime that you had immediately post-COVID, and then the regime that you had for the 12 years after the financial crisis.
So I want to pivot now to close out the panel with a little bit of a rapid fire exercise. So I'll start with you, Mark. So what's one assumption that investors should reconsider going into the second half?
What's one assumption investors?
Like, some sort of universally accepted.
Well, so I think it's related to what Zach was talking about. Like one of the things that we're spending a lot of our time trying to figure out is like how sensitive is the AI CapEx that everybody is planning and assumed to tightening in financial conditions, right? We're just starting to see that tightening start, and it's going to be very important to figure out how rapidly CapEx intentions change on the back of that, or not, right? Like that's one of the most important questions I think we'll be working on.
Zach?
Same question?
Yep.
That the Strait of Hormuz will reopen anytime soon or ever.
Yeah, and what that means for the global economy if oil demand's unable to be satisfied.
I would say maybe two things. I'll cheat a little bit. One, I'll piggyback a little off of Mark and say the opportunities emanating from AI are massive, right? Because AI is an exponential layered on top of an exponential layered on top of an exponential, right? These chips are getting like 10 times better, 2 times per year. These algorithms are getting like multiples better every few months. The spend on this stuff and the decrease in token price, the use of tokens, these are all exponentials. And analysts in the market are not good at exponentials. Right? Every analyst for memory or for software or anything is trying to go back to other cycles of whether it's kind of the smartphone or whether it's the PC or whatever, and just kind of apply the same math that you had then. But you just can't. It's different, right? This is growing too quickly. And I think that, again, on these terminal basis, you could see it every quarter, just earnings, and you just have to do the recalculus completely different, right? Because you've just surprised too much. The other thing is just what was mentioned before is Kevin Warsh, right? Like, I would argue that Bernanke to Yellen to Powell were all essentially the same, and they all conducted monetary policy in the same manner. But now you have someone who's come out and really for the past 15 years has been very resolute in his feelings about how current central banking is operating wrong, right? And he's been, I think he's been very consistent. He feels like the preponderance of evidence is on his side. And I don't know the manner of which it's going to unfold. I don't know the time period of which it'll unfold, but I think over the next few years, and probably front-loaded, you should be prepared for a very different Fed, which is conducting monetary policy in a very different way.
Yeah. All right, I guess I'll give mine before we close it out. I think that on the AI side, I think investors should reconsider whether productivity gains will in fact be satisfied by the multiple levels of improvement in AI over a very short period of time. All right, with that, Brian, Zach, and Mark, thank you so much. This has been a great discussion.